Hello and welcome to The Other View, and I am Omar Saleh. If you recall, in the last video I discussed a concept I call what makes a business tick, with three metrics that were the top line, the profit or profitability, and the operating expenses or the expenses and costs of running a company. This video talks about what I would call company life cycle in this case, which is basically a natural follow-on from last video. I am going to be a little bit controversial of whether it's a company life cycle or a product life cycle, because I am borrowing the typical product or service life cycle to create from it how I think of a company life cycle as well. So basically, if you recall from the last video, we said that generally speaking, if you are one company with one product or one service, then you can basically go through different types of phases of your life by attacking the market and going for a market expanding phase in your life, where you focus very much on sales and on revenue and on income. And as a result, you raise your expenses and costs and operating expenses, and you more or less sacrifice a little bit on your profit or profitability or margins, and that basically your aim in a market expanding part of your life cycle is to actually gain market share, to increase your share of the total market for your products, okay, or that particular product or service that you are tackling at the time. Then a lot of companies, they come to a stage where you have occupied or achieved some of the objectives you wanted, and as a result you then need to start reinvesting in the future. So you start going back into what we call market consolidating part or phase of your life cycle, where you try to take out profit out of the business. So you squeeze the profits, you squeeze the operating expenses, and you try and maximize your profit and profitability, and you try to add some of that profit to reward your shareholders and employees and reinvest in the business, and then after that basically you make sure that you have sufficient funds to fund your growth into the future, your investments as well. So basically the company life cycle, you go up by increasing your market share into market expanding, then you try and consolidate, and you take out profit, and you go up and down in a sinusoidal type of way. Now, most companies don't have one service line and don't have one product, so otherwise you would end up in a stop-start type relationship. So even if you were a big company like a Unilever or Procter & Gamble or an IBM, you have a multitude number of products and services. And what you try to do is you run them as portfolios, and you make sure in your strategic planning and your operational planning that where at least the net effect of any phase, whether you're market expanding or market consolidating, that at any one time you are taking the company in an upward direction by creating the portfolios in such a way that you continue to grow that company rather than go through dips and ups and downs. So there you have a portfolio of products. And even if you're a plumber, or if you're an electrician, a small plumbing company or electrical company, you don't only have one product or one service. A plumbing company could specialize, for example, one product is in doing bathrooms, or it could do in doing plumbing in a house only, or working for insurance for flooding. So you have a number of services as a plumbing company or as an electrician, yeah, in that you provide. So those services as well, you change the pricing of the mechanism, and you actually focus on what are the most profitable ones when you're trying to consolidate and take out profit out of the company, or you try and run after the ones that bring you higher sales and higher revenue. So company life cycles move in similar way to product life cycles. There is a market expanding part, and there is a market consolidating part. The only difference between the two is that if it's a single product or a single service, it is very bitty in the way it grows and it comes back down. But as a company, when you have a portfolio of products, it is more demanding in making sure that your mix of portfolio carries on in an upward direction at a rate that you are able to basically invest in and to grow in. Don't forget that the most important part that you mustn't take your eye off the ball about is that the more you occupy of the market share within your market, the more you're able to play with the various metrics that enable you to grow when you want to grow and to milk the profit when you want to milk the profits. So basically, if you are controlling the market share, or you are one of the top 3 market share companies in your market, then you're able to play with the pricing. Also, if you are the lowest cost producer in your market, you're able to play with the same sort of pricing mechanisms to enable you to decide when to grow and when to take out the profitability out of the company and invest it back into it in terms of your employees, or in terms of more efficiency and productivity, and so on and so forth. So company life cycles basically go market expanding, market consolidating, market expanding, market consolidating. And a life cycle, most companies, for going from one part from market expanding to market consolidating, one cycle is somewhere around 2 to 3 years for large organizations, medium and large organizations. I say 1 to 3 years simply because generally speaking, in those, it varies by industry. There are some industries go through that cycle faster than other industries. And the indicators, when you look at companies, you'll find that as the as the share price and the programs you see from companies and the offers that they give for their products and their portfolios are an indicator of what stage in their life cycle they are at when you go to buy their products and services. And that's it. So a company life cycle is an indicator of what the company is focusing on at the time. Is it going through market expansion, or is it going through market consolidation? And the going from one to the end of another is the life cycle itself, and that's 2 to 3 years, generally speaking.